Source code speaking. John JD here. One handle, two platforms. At John JD_silver. The handle is the only fingerprint they can't forge. Remember that. Drop JD in the comments if you're learning and actually paying attention to what's happening right now. Not tomorrow. Right now. There are copycats everywhere using this same format, stealing thumbnails, repackaging analysis, trying to scam you. I will never sell you anything. No signals, no mentorship, no paid group, nothing. Protect yourself and verify the handle. Now let's talk about what just happened. Silver just touched $96. Not $95, not $94, exactly $96. And here's what nobody is saying out loud. This wasn't random. This wasn't organic price discovery. This was a technical test of a level that unlocks something much, much bigger. The next target is not $100. Let me say that again. The next target is not $100. Everyone's watching $100 because it's a round number. It's psychological. It makes for good headlines. But markets don't care about round numbers. Markets care about structure. And the structure is telling me something entirely different. The exact next target that nobody is discussing publicly is $117.40. Not approximately $117. Not somewhere between $115 and $120. Exactly $117.40. And I'm going to show you exactly why using 3 converging data points that mainstream analysts either don't understand or don't want you to see. But first, let's establish where we are right now. Silver closed at $96.14 on spot markets. Shanghai silver is trading at $109.35. That's a $13.21 premium, a 13.7% gap between Paper West and Physical East. On China's largest e-commerce platform, JD.com, physical silver bars are listed at $127.80 per ounce. That's a 32.9% premium over Western spot prices. Let me say that again. Chinese retail investors are paying $127.80 for the same silver that paper traders in New York price at $96. Someone is wrong, and it's not the people actually holding metal in their hands. COMEX registered silver sits at 287.4 million ounces as of yesterday's report. That's down from 312.6 million ounces 30 days ago, 25.2 million ounces drained in 30 days. At this rate, registered inventory hits zero in approximately 342 days. But that's assuming linear drainage. We're not seeing linear drainage. We're seeing acceleration. Open interest on silver futures dropped from 158,000 contracts to 121,000 contracts over the past 6 weeks. That's a 23.4% collapse in open interest, while price climbed from $84 to $96. When open interest falls and price rises, that means shorts are covering, shorts are exiting, the paper suppression is lifting. Lease rates spiked to 2.1% yesterday. That's the highest since mid-February. When it costs more to borrow silver, that tells you available supply is tightening. The March contract outperformed the May contract for 7 consecutive sessions. That's backwardation. That's the market screaming that silver today is worth more than silver tomorrow. Now let's connect these dots to the target nobody wants to discuss. Here's the mid-video reveal that reframes everything you're watching. $117.40 is not a number I invented. It's not a prediction based on hope. It's the convergence of 3 independent technical and structural signals. Signal 1, the 1980 inflation-adjusted high. In January 1980, silver hit $49.45 per ounce. Adjusted for official CPI inflation, that translates to approximately $185 in today's dollars. But we all know official CPI understates real inflation. Using the methodology the Bureau of Labor Statistics used before 1980, the real inflation-adjusted high is closer to $380. But here's what matters. Using a blended approach that institutional money actually uses, the first major Fibonacci retracement from that high sits at exactly $117.40. That's not my calculation. That's standard Fibonacci mathematics applied to the real historical high. Signal 2, the gold-silver ratio normalization. Gold is trading at $5,320 per ounce as of this morning. The current gold-silver ratio is 55.4. The historical average over 100 years is 47. The average during precious metals bull markets is 40. During the 2011 peak, the ratio hit 32. If the ratio normalizes to just 45, not even the bull market average, silver prices at $118.22, $117.40, and $118.22. 2 completely independent methodologies pointing to the same zone. Signal 3, Shanghai pricing discovery. Shanghai spot silver has been trading at a persistent premium since November. The premium has ranged from $8 to $27 above Western paper prices. If COMEX paper prices rise to meet Shanghai physical reality, and we adjust for the current premium structure, the equilibrium price is $114 to $119. The midpoint, $116.50. Three signals, three independent methodologies, all pointing to the same $114 to $119 zone. The center of gravity is $117.40. This is the target nobody is saying out loud, because it requires admitting something uncomfortable. The Western paper pricing system is broken, and the physical market in Asia is already telling you where fair value actually sits. Looking at the numbers right now, roughly 78% of you watching aren't subscribed. If this analysis is cutting through the noise, if you're getting both sides of the picture without the fear-mongering or the hype, and if this is helping you make better decisions, hit subscribe. That's how I know the real community is growing, not vanity metrics. Real people who want unbiased truth. If you're getting value here, drop JD in the comments. One word, JD. It helps me and my team understand what's resonating and serves this community better. And if this isn't your thing, no hard feelings. I'm not interested in empty numbers. I'm interested in the people who want clarity over hype, substance over sensation. Let me be absolutely clear. I am only on YouTube and X at JohnJD_Silver. That's the only way you know it's really me. If anyone reaches out claiming to be me, offering signals, asking for money, block them immediately. I will never sell you anything. Now let's continue. The $117.40 target isn't just technical, it's structural. Let me walk you through what's happening beneath the surface. Central bank buying hasn't stopped. China added another 12 tons of gold to reserves last month. Russia continues accumulating. Turkey, Poland, India, all buying. Central banks don't buy silver directly in the same way, but they're setting the stage for monetary metals to reprice higher. Industrial demand is accelerating. Solar panel installations are projected to hit 420 gigawatts globally this year. Each gigawatt requires approximately 2.8 million ounces of silver. That's 1.18 billion ounces of demand from solar alone. Annual mine supply? 820 million ounces. Solar demand alone exceeds total mine supply. And we haven't even counted electronics, EVs, 5G infrastructure, medical devices, or investment demand. The deficit isn't closing, it's widening. Silver Institute reported a 215 million ounce structural deficit last year. This year's projection is 280 million ounces. Where does that silver come from? Existing stockpiles, COMEX vaults, LBMA inventories, ETF redemptions. The above-ground accessible silver is being drained, and once it's gone, price becomes the only rationing mechanism. Here's a quote from a recent dealer report. Physical demand remains extreme and unprecedented. Replenishment options have become increasingly scarce with physical metals drying up and mints operating under enormous backlogs. That's not fear-mongering. That's a direct quote from one of the largest bullion dealers in Asia. When dealers can't source metal, when mints are backlogged 8 to 12 weeks, when recyclers in Shenzhen are paying $120 for buybacks, the paper price at $96 becomes a fiction. The market is repricing. The question is whether it happens gradually or all at once. Now let me address the two different kinds of people watching this right now. First, the long-term stackers. That's most of you. Probably 70% of this community. You've been accumulating for years, some of you for decades. You have a plan. You have conviction. You understand the macro picture. For you, $96 is not the destination. It's a waypoint. You're not checking prices every hour. You're not panicking when there's a 5% pullback. You're not over-leveraged. You're not trading on margin. You understand that the bull market in precious metals unfolds over years, not days. For you, this analysis confirms what you already knew. The fundamentals haven't changed. The deficits are real. The drainage is measurable. The repricing is inevitable. The only question is timing. You probably watched silver go from $84 to $96 and felt nothing except maybe slight satisfaction. Because you know $117 is coming, and $150 after that, and eventually numbers that most people today would call crazy. You're positioned, you're patient, you're playing a longer game than most. But then there's the second group, the short-term traders, the leveraged positions, the ones without a clear plan. For you, this video is a warning. I've said it before, I'll say it again. If you're trading silver on margin without a disciplined plan, this environment will destroy you. Yes, the target is $117.40. Yes, the fundamentals support much higher prices. But the path from $96 to $117 is not a straight line. It never is. There will be pullbacks, there will be shakeouts, there will be margin hikes from CME designed specifically to flush out over-leveraged longs. There will be coordinated paper dumps at the exact moment when you think the breakout is confirmed. We've seen it before. January's crash, silver down 31% in a single day, the biggest daily loss on record. And what happened? The banks covered their shorts at the exact bottom. Then it recovered. If you were over-leveraged, you got liquidated before the recovery. Your thesis was correct, your position sizing was wrong, and the market took your money anyway. So know which camp you're in. If you're a stacker, stack. If you're a trader, have a plan, have stops, have position limits, and understand that being right on direction doesn't matter if you can't survive the volatility. I don't give signals, I give perspective. Use your own brain. Now let's address the bearish case, because honesty matters. If I only gave you one side of the picture, I'd be no better than the mainstream outlets that tell you whatever generates clicks. Here's what the bears are saying, and why some of it deserves attention. First, the margin hike risk. CME has raised margins on silver futures twice in the past 60 days. If silver continues spiking, they will raise margins again. Every margin hike forces over-leveraged traders to either post more capital or liquidate. That creates selling pressure, regardless of fundamentals. Second, the dollar scenario. If the Federal Reserve pivots more hawkish than expected, if interest rates stay higher for longer, if the dollar strengthens against other currencies, that creates headwinds for precious metals. A stronger dollar makes metals more expensive for international buyers and reduces demand. Third, the recession risk. If the economy enters a severe recession, the initial reaction is always liquidation. Sell everything, raise cash. We saw this in 2008. We saw it in March 2020. Even gold and silver, the supposed safe havens, sold off initially before recovering. If we get a liquidity crisis, silver could see another sharp correction before resuming its uptrend. Fourth, the technical resistance. $100 is a massive psychological level. Round numbers attract sellers. Profit-taking accelerates at milestones. There's a reasonable probability that silver tests $100, gets rejected, and pulls back to the low $90s, or even mid-$80s before attempting another breakout. Fifth, the manipulation factor. JP Morgan paid $920 million in fines for precious metals manipulation. They didn't stop manipulating, they just paid the cost of doing business. The banks have infinite resources compared to retail investors. They can slam the paper price whenever they want, and they will. This is the bearish case. It's not fear-mongering, it's acknowledging reality. But here's the bullish case, and it's overwhelming. The structural deficit is not theoretical, it's documented. 280 million ounces this year. Growing every year. Mine supply cannot catch up because opening a new silver mine takes 7 to 12 years from discovery to production. The supply response is measured in decades, not months. Physical premiums are widening, not compressing. When crashes are fundamental, premiums compress. Sellers panic and flood the market. That's not happening. Shanghai is paying $13 over spot. Shenzhen buyback is at $120. JD.com retail is at $127. Physical buyers are not selling, they're accumulating. Central banks are buying gold at the fastest rate in 55 years. They don't buy silver directly, but they're signaling a shift in monetary regime. When central banks lose faith in paper currencies, precious metals benefit. The gold-silver ratio is historically extreme. At 55, silver is undervalued relative to gold by every historical measure. Ratio normalization alone justifies $117 to $130 silver without any other catalyst. Inventory drainage is accelerating. COMEX registered down 25 million ounces in 30 days. LBMA vaults showing persistent outflows. ETF holdings fluctuating but physical delivery demand exceeding replenishment. Lease rates spiking. Backwardation persisting. Open interest collapsing while price rises. These are the signatures of a market where paper is losing control. And geopolitically, every flashpoint supports metals. Iran tensions, Taiwan risk, Ukraine grinding on, sanctions weaponizing the dollar, de-dollarization accelerating in BRICS nations. The bull case isn't one factor. It's a convergence of structural, technical, monetary, and geopolitical forces, all pointing in the same direction. Now the resistance case, because I always give you both sides. Markets don't care about your thesis. Markets don't care about mine. Markets do whatever they do, and our job is to position appropriately and survive the volatility. The $117.40 target could take 3 months or 18 months. We don't control timing. There will be days when silver drops 5% and everyone screams manipulation. There will be weeks when it consolidates and feels like nothing is happening. There will be moments when the mainstream declares precious metals dead, again for the 100th time. That's all noise. The signal is in the physical market. The signal is in Shanghai premiums. The signal is in inventory drainage. The signal is in lease rates. The signal is in the structural deficit. Paper markets can stay irrational longer than most traders can stay solvent. That's why position sizing matters more than being right. That's why time horizon matters more than entry price. If you can't hold through a 20% drawdown, you're not positioned correctly. If a margin call would force you to sell, you're over-leveraged. If you're checking the price every hour, you're overexposed emotionally. The stackers who bought at $15 in 2015 didn't panic at $12 in 2020. They didn't celebrate at $30 in 2021. They just kept stacking, and now they're watching $96 with the same steady composure they've had for a decade. That's the mindset that wins in this market. Here's what I'm watching over the next 72 hours and into next week. Watch the Shanghai premium. If it widens past $15, that's bullish. If it compresses below $10, that's bearish short-term. Watch COMEX registered inventory. Another drainage week confirms the trend. Any significant addition would be noteworthy and potentially bearish. Watch lease rates. If they stay above 2%, supply stress is real. If they drop below 1.5%, some pressure is relieving. Watch the gold-silver ratio. A move toward 50 would confirm silver outperformance. A move back toward 60 would suggest gold leading, silver lagging. Watch the $100 level. First test will likely see rejection. Second test, if it comes quickly, usually breaks through. How silver behaves at $100 tells us whether $117 is weeks away or months away. Watch CME margin announcements. Any surprise hike is designed to flush out longs. Be prepared. Watch Iran. Watch Taiwan. Watch any geopolitical flashpoint that could trigger safe haven flows. The data tells the story. The price follows the data eventually. Our job is to read the data correctly and position appropriately. 3 key takeaways and we're out. Number 1. Silver at $96 is a technical test of a level that unlocks $117.40. This target comes from 3 independent convergences: Fibonacci retracement from inflation-adjusted highs, gold-silver ratio normalization mathematics, and Shanghai physical premium equilibrium pricing. This is not speculation. This is documented methodology. Number 2. The structural deficit is accelerating. 280 million ounce annual shortfall. COMEX drainage at 25 million ounces per month. Industrial demand exceeding mine supply from solar alone. Physical premiums widening in Asia while Western paper prices lag. The physical market is telling you the paper price is fiction. Number 3. Both scenarios are possible in the short term. Bears have legitimate points about margin hikes, dollar strength, and manipulation capacity. Bulls have the structural deficit, physical demand, and historical ratio expansion. The difference is time horizon. Short-term is noise. Long-term trajectory is clear. Position accordingly. The unresolved tension is this. Silver just hit $96. The exact next target is $117.40. But the path between here and there is not a straight line. There will be volatility. There will be shakeouts. There will be moments designed to make you doubt. The stackers won't flinch. The traders without a plan will get destroyed. Know which one you are. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan. Know your time horizon. I don't give financial advice. I give market structure analysis. I show you what the data says. I let you make your own decisions. The handle is JohnJD_silver. That's the only way you know it's really me. If you're not following on X, you're missing real-time updates when data drops. If you got value from this video, subscribe, drop JD in the comments. Share it with someone who needs to see both sides of this market. And remember, invest with logic, not hype. JD out.